functions of the Fed. I'm going to start off with some tools of the Fed today. Tools of the Fed. So all of these tools, there's three tools that they use to control the supply of money. Now money, remember, is more than just currency. It's those banking accounts, checking and savings primarily. All of the accounts in the nation plus currency make up what we call the money supply. And that's an important feature that we went over last time because there's not enough currency for everybody to get their money all at one time. So the banking system is a little bit of a leverage concept where you put your money on deposit at the bank in your checking or savings account, and if everybody went to the bank at the same time, there's not enough there. And that was one of the reasons banks tended to fail early on until the establishment of the Federal Reserve Bank in 1913. So how does the Fed control the money supply? So these are what these tools are about. Number one, it sets what's called the discount rate. The discount rate. So the discount rate is the interest rate, the interest rate charged to member banks for short-term loans. The interest rate charged to member banks or institutions, to member banks for short-term loans. So, this is the only interest rate that the government sets. The Federal Reserve sets, anyway. This is the only one that they set. So you're often misled by the media where they say, oh, the Federal Reserve raised interest rates or lowered the interest rates or something like that. All those interest rates that we normally deal with, even down to your interest rate on certificates of deposit or your lowly savings account interest rate we talked about last time, the rate you pay on your car loan, the rate you pay for a home mortgage, all of those rates are set by the marketplace through what we saw in the previous chapter of the demand and supply of loanable funds. People who want to borrow money, people who want to loan money. They get together and the price of borrowed money is the interest rate. That's the amount you're going to have to pay back. So if you're getting paying a 10% interest rate and you borrow $1,000, you're going to pay $100 for the use of that money over the time you didn't pay it back, right? So the interest rate truly is a payment for borrowed funds. So the only interest rate that the government sets is this one. And this is what that interest rate is, the interest rate charged to member banks for short-term loans. Why are they making loans? Well, they might be in trouble, although the Fed has gone away from this. So some reasons the bank may be short on required reserves. Big RR. We talked about required reserves last time. What was that? Dig back in your notes. The bank may be short on required reserves. What were required reserves? Yeah, that they have to hold back, that they can't loan out, right? So our fractional reserve system is set up that they can't loan out 100% of your money. They can only loan out a fraction of it. So whatever that fraction is, if they're required to hold back 10%, and then a whole bunch of people come and make some withdrawals that day, they could come up short on what's required of them by the Fed. In that case, especially if it's just kind of a short-term hiccup, they can go to the Federal Reserve and say, hey, give me a loan. Was that a ring? It was so subtle, I guess I'm going to let that one fly. They can say, hey, how about if I just borrow the funds? I think we'll be fine tomorrow. We'll get some more money in. But for tonight, we're short. We're screwed without a loan from the Fed. So the Fed's going to charge them money to essentially loan them for a very short time. Could be 3 days, could be even one night. A very short-term loan. So that is the only interest rate under the direct discretion of the Federal Reserve. All other stuff that we'll get to in a moment tends to influence the market rates. It's not set like it's going to be 1% or it's going to be 1.5, but rather it's influenced. Okay, so that's our first tool. Questions on that one? The discount rate. Number 2 is tied into our first bullet point. They set the required reserve ratio. So they set the required reserve ratio. That is the fraction that needs to be held back. I called it little RRR last time. We did a short little equation. Some amount of deposits have to be held back. If it's 10%, it's 10%. If it's 11%, then there's a little bit more that can't be loaned out. We'll see the impact of that here in a little bit. So they set the required reserve ratio. And then the last tool is the one that's used the most frequently. And that is open market operations. Open market operations. And what the Fed's doing here is either buying or selling bonds in the open market. So they are going into the marketplace and purchasing bonds, typically government bonds. We'll talk about bonds here in a second. So this is the purchase or sale of bonds in the, let's just put quotes here, free market, meaning just private individuals can buy and sell bonds.